Welcome to Planning for Retirement with Scott Nelson. Plan well, retire happy.
Hello, everyone, and welcome back to another episode of Planning for Retirement. My name is Scott Nelson. I'm joined today by my daughter Elise, who is learning the ropes very quickly. And we're really excited today to have Alecia Barnett from Financial Independence Group. I'm not sure what her official title. I think it's Great High Poobah Expert of all things long-term care, something along those lines. Super senior VP or something. But Alecia is actually traveling the country doing classes both for seniors approaching retirement as well as for professionals like myself to help us be more up to speed and serve people better in the long-term care arena. So excited to have you, Alecia. Welcome.
Thank you so much. I'm glad to be here.
So when it comes to long-term care, I heard Tom Hegnam recently say that no retirement plan is complete without a plan for a long-term care event. So with that in mind, I know Elise, being somewhat new to the industry, has a list of things she would like to know. And I'm going to just smile like a proud father and sit back and let Alecia answer all the questions.
Yes. So my first question, what are the key factors individuals should consider when planning for long-term care needs?
That's a great question. So, as Scott mentioned, long-term care should be a big part of the financial plan. What people don't typically understand is that if you haven't allocated something, you've allocated everything. So I think some of the most important things to consider is how much is care going to cost? A lot of people really, frankly, don't know how much care costs. It's expensive. There's a fantastic website I always recommend going to. You can go to longtermcare.gov. There's some great general information in there. And then there's a cost of care link. If you click on that link, it's going to take you back to the Genworth Cost of Care survey. You can actually type in your location anywhere in the country, and it's going to tell you exactly how much care costs. So when you're considering a plan or putting a plan together, again, cost is going to be, how much does care cost? So you want to know nursing home or assisted living or home health care. Right now, the average cost around the country is around $90,000 a year for nursing home. So typically what I recommend when you're planning is let's at least cover half of that cost. And that's typically going to cover up to 100% of home health care and assisted living. Then you can dial it up or down based off your comfort level. How much of that risk do you want to take on? The next thing you want to consider is how long do you want the plan to last? Averages is like drawing a line down the middle. So you can get anywhere from a 2-year benefit, meaning your long-term care policy will pay out for 2 years, up to an unlimited benefit, which is true longevity protection. So you want to take that into consideration when looking at a long-term care solution. And then, of course, another key factor is inflation. We all know cost of care is going up. If you're young, you want to include inflation in your policy to keep up with the cost of care. For example, if you're 60 and you don't need it till you're 80, it can be significantly higher. And then last but not least is how are you going to fund the plan? There's a number of different ways that you can fund the plan. For example, you can use income, you can use qualified dollars, you can use highly appreciated non-qualified annuities. So there's a lot of different ways that you can fund those plans. And I think that's important to consider when putting a plan in place, if that makes sense. Elise?
It does. And I appreciate you bringing up all the different vehicles that you can use to pay for long-term care. I think a common misconception that a lot of clients that Scott sees, they think that Medicare will cover long-term care. And so we have to educate on that it does not cover long-term care.
That's exactly right. In fact, that's one of the biggest myths I cover when I'm talking to clients at my educational events all across the country. There's a lot of misconception when it comes to Medicare and Medicaid planning. And I always ask the question at the beginning of the event, how many people think the government's going to take care of you? I always get a chuckle. But in all seriousness, there are stipulations that go along with those. For example, Medicare, you have to be hospitalized at least 3 days. It covers up to 100 days of skilled care. It's really short-term care, not long-term care. And then Medicaid, you have to spend down your hard-earned assets to be able to qualify. And it typically only covers care in a facility, not in the home. And I don't know about you, but I certainly want to receive care in the home if I can.
Yes, for sure.
Yeah, that Medicare part, it's, I don't know if I even want to call it short-term care. It's really rehabilitation, right? It's getting you strong enough to safely return home. If you aren't strong enough to safely return home, it's cheaper than inpatient hospitalization, but it's not long-term care, custodial care.
And you
Exactly
did,
right.
yeah, you did touch on the Medicaid portion just a bit. Can you talk about the eligibility criteria for
Uh,
government funded?
Absolutely. So unfortunately, there's a lot of states. So all the states are different when it comes to the Medicaid limits. But the way that it works is if you're married, your assets have to be under a certain limit, and it's really based on your assets, not your income. Although you have to be basically impoverished, and typically you're going to see less than, I think, $2,000 of income. So again, you have to really. It's a means tested system. You have to qualify there. You can't give away your assets and then expect to qualify. There's a 5-year look back on that. So if, for example, I decided one day I'm going to just give my money, try to give my money to my children. If I need care within that 5-year period, Medicaid can come back and ask for that money, or you just simply won't qualify. You can typically, your home is going to not count against your assets. If you have a vacation home, for example, that will. So there's a lot of different stipulations that go along with that, but it is state specific. So I don't want to go into details since it is state specific as to the actual dollar amounts.
Right, right. Did
Yeah,
you?
basically you have to be broke,
That's
Yeah.
exactly right.
according to Medicaid's definition of broke.
Yes.
And one sad case we had come through here, a family came, mom was in the skilled nursing facility, and the staff at the skilled nursing facility read off the eligibility criteria for a single individual. And so, bless his heart, her husband was trying to, you know, become broke and not knowing the community spouse rules, that there is provision there for the community spouse to not be completely left destitute. So it just pays to know the rules.
It does. And if you have a spouse, you could leave your spouse impoverished if you don't plan accordingly. I think that's one of the biggest things that people don't understand as well is you can't simply just say, oh, I'll use I'll move my assets. It's the combined assets.
And how would you recommend families approach conversations about long-term care planning for those either aging relatives or even spouses? How do you go about that conversation?
I think you have to get the next generation involved because oftentimes, if you don't have a plan in place, then it's your oldest daughter in closest proximity. That often causes problems within the family dynamics. I always say long term care doesn't bring families together, it tears families apart. So I think it's important to have the conversation with your family as to where you want to receive your care, who you want to take care of you. And then obviously, I think it's important to be able to talk with a financial professional and show the different options so that you don't have to self fund because it is the biggest mistake in your retirement income plan, and people typically don't understand that. So I think the biggest thing is to have a written plan of care, share that with your family member, share that with your healthcare power of attorney, and then look for alternatives or efficiencies to pay for those services, if that makes sense.
It does, yes. What is it that you, Scott, tell people in classes for planning the long-term care, the options?
Well, basically you can self-pay, which like Alecia says, if you don't set aside some assets dedicated for that purpose, you've dedicated all of your assets for that purpose. You can rely on family, but frankly, most of us are kind of independent minded. If it's the choice between being dead or moving in with my kids, I think I'd rather be dead. I just,
I have offered.
yeah, she has. And yeah, she's not alone, but yeah, I'm blessed. Um, you can go with a traditional long-term care plan, which comes in different forms in terms of how it's paid. We have some plans where you can actually take retirement assets, and we're often talking because of our association with David McKnight and the group at Power of Zero. We're talking about doing Roth conversions and so forth, and that fits well there, where you can take qualified dollars, put them into an annuity, and have that pay premiums on a long-term care policy over 10 years, say, and then it's set. But there's also the ability to use life insurance like an indexed universal life policy with an accelerated death benefit for chronic care. And we've seen all of that done. So certainly it's much better if there's assets dedicated for the purpose and the family's talked and there's a plan in place. It's not like it's a big shock because, mom fell and broke her hip and she can't, it's just not going to get better kind of a thing.
No, that was it. We in the classes he educates a lot about having a will, having a trust in place,
Powers of attorney.
powers of attorney for when that time comes. A lot of people think that will never happen to me.
Exactly. And one thing that I can add too is when you brought up wills and trusts and everything. So one of the things that I always recommend is when you're looking at your plan, since most people don't understand that if you haven't allocated something, you've allocated everything. The thing to keep in mind, and maybe when you're talking to your family, is letting them know which assets you would liquidate first if you were to need some type of care. That is a good thing to be able to put in your written plan of care so that they know how you're going to fund it. And what our job to do, Scott and Elise, is to really add efficiencies to those plans. Which we can reposition an asset or income into one of these solutions, whether it's life insurance or annuities or a traditional long-term care plan, whatever that may be, we can add efficiencies to that plan. But the first question that you want to have answered is which asset you would liquidate first.
Yep. And we do that. We talk through that. So great points.
A question I have, are there any products that are some of your favorite to suggest to people when they're planning their long-term care?
Absolutely. I do have favorites. The good news and the bad news is there are a lot of options. But that's why we have a dedicated team here at Financial Independence Group to be able to do that heavy lifting because it's not a one size fits all approach. If you're young and healthy and a high income earner, I really like the life insurance avenue. I like to use the analogy owning your policy versus renting it. So the traditional long-term care policies are the cheapest way to buy the most amount of long-term care. But if you don't use it, you don't lose. If you live a long life, you've paid all these premiums in, you don't get those premiums back if you don't use it. So that's a big objection commonly that I see in the traditional long-term care space. Also, those rates can go up, and there's no exit strategy. So if you change your mind, you can't walk away. So again, renting versus owning. The life insurance side of the house, you might pay a little bit more, but you have guarantees associated with those. So for those younger clients, you can stretch the payments out over time, anywhere from a 10 pay all the way to a paid to age 100. So really for your life. And from a cash flow perspective, that makes the most sense. So on the life insurance chassis, those premiums are guaranteed, unlike the traditional. But if you wake up an angel and you never need any care, there's a death benefit. And also there's an exit strategy. So you can take some of your money or all, depending on the solution, if you change your mind. So, I like the life insurance for the younger folks. For the older folks, there's some fantastic annuity chassis, meaning it's long-term care on an annuity chassis. Now, these are dedicated truly for long-term care, the annuity is secondary, but essentially what you can do is if, for example, you have an existing annuity, you could potentially 1035 that in, tax deferred, tax-free transfer, and if you need care, any gains in that contract will come out tax-free for care, and there's additional leverage. So for example, if you put in 100, you might get $300,000 day one for long-term care purposes. So it gives you more leverage for those older clients. So I really like to go that route for the older folks. And then, of course, if you have money sitting in the bank and you're not using it, and maybe it's your rainy day funds and you don't need it for income, you can just do a reposition of a single premium asset into a life insurance or annuity policy. So there are a bunch of different ways to do that. But it would really depend. I don't like giving a one answer for that, because it isn't a one size fits all approach, which is why it's important to talk to a financial professional, because 10 people could have 10 different plans, if that makes sense to you.
It does. And what's great about coming to a financial advisor like Scott, he can come to you, the expert.
I do.
Right? And so
I absolutely
we do.
Yeah.
So we have experts behind us to let us know, and I like how you put out there, if you're younger, here's what's the best thing. If you're older, here's the next best thing. What did you say? The best time to plant a tree was 20 years ago.
Next best
Exactly
time
right.
is today.
Yeah, today.
I always say you've never been younger and healthier than you are today. So people always ask me, how old should you be when you buy it? As young as you possibly can.
Right now.
Yeah, true. How old is the youngest client or case that you've been familiar with for long-term care policy?
I have actually seen all the way down to 18. And the reason that I've seen that low in age is it's very unusual, yes, but it's because some of the states are trying to come out with these long-term care taxes to pay for a state-funded plan. For example, Washington implemented a state-funded LTC plan a few years ago, and if you were 18 or older and working and a 1099 employee, then you could potentially, if you didn't have a private 7702B LTC plan, you pay a tax. So we saw people as young as 18 purchasing plans to be able to opt out of that state tax.
Do you see that going across other states?
California.
So California is probably the closest. We honestly don't know if and when, but they're definitely down that hole. And I believe there's roughly 14 other states that are looking or at least researching it, because Medicaid simply isn't going to be able to pay for it. And a lot of people don't have the funds to be able to pay for it. So what's going to happen? Medicaid is a Band-Aid. And I think that states are starting to realize that, and this is just a temporary fix. So I think you're going to see more and more states kind of follow suit with Washington and California.
More taxes.
Well, in effect, that's really what it is, truly.
Yep.
So, I mean, Medicaid, it's welfare. It's there as a safety net, but a lot of people just have the mindset that, oh, well, Medicaid will pay for that. And Medicaid and Medicare get confused a lot. It's just not the case. And all of a sudden, usually skilled nursing is not the first solution. Usually that is on the heels of having tried to do all the care at home with the family doing the round the clock care, and they're frazzled, they're not thinking well, and then suddenly they've got to go to a nursing home and they're thinking, well, we'll care for them so that we get our inheritance. That's not really what the thought process is, but it can be part. And then the nursing home says, well, that's going to be $9,400 a month. How will you be paying for that today?
Exactly.
And off you go.
So after somebody has these policies in place, when they are in need of it, how does that process work?
That is a great question. So the 7702B long-term care plans that I handle, which is essentially a tax qualified long-term care plan. So they're all uniform in their definition as to how you trigger the policies. So the way that it works is if you need some type of care, your doctor must certify that you can't perform 2 of 6 activities of daily living. And that's your normal everyday stuff: bathing, dressing, toileting, transferring, eating, continence. Or you cannot or you have a severe cognitive impairment. So 2 of 6 ADLs, as I like to call it, or a severe cognitive impairment for at least 90 days or more. So that's the standard definition. And then each policy out there, each solution has what's called an elimination. So an elimination is essentially a deductible, like with health insurance or homeowners, et cetera. And the way that that works is you're going to see typically on the solutions that I handle anywhere from a 0-day to a 90-day elimination. So for example, if you need care and you have a 90-day elimination, you have to pay 90 days out of pocket. So that's going to differ from solution to solution. So that's something I should have mentioned before, is that's important to look at when you're picking out a plan. On the life insurance solutions out there with chronic illness riders, they're typically a 90-day elimination. So it just depends on the solution. Every carrier out there, every solution out there can be different.
And is that out of pocket? Is that reimbursed? Or is that just your out of pocket?
Yeah, no, you get to pay that. It's like a deductible.
Okay.
Elimination period, think of it as a waiting period. You need to be getting care for this long, and then benefits will kick in. A 0-day elimination period sounds wonderful because it's going to start right out the gate as soon as the doctor signs the letter and you're in care. However, your premiums are going to be substantially higher than they would be if you had a 30 or 60. The sweet spot tends to be 90, doesn't it?
That is correct. That is correct, Scott. 90 days is definitely the sweet spot. On a lot of the what we call asset-based LTC solutions, which are written on life insurance or annuity chassis, there's no way to manipulate those. Typically they're 90-day and maybe a 0-day wait in the home. On the traditional plans, a 0-day is going to be a lot more expensive than a 90-day. So that is 90 days is the average of what we see on the standalone or traditional LTC plans.
No, that's great to know. I mean, especially for our listeners who are maybe thinking of talking with relatives about a long-term care policy. That's great. That's great to know.
And that's one of the reasons we suggest strongly that people have a 6-month emergency fund. It's not that you're not going to have the income for 6 months to pay stuff. It just makes for a nice number to address things like if there were a long-term care event and you needed to take care of that elimination period, there you go. You've got it. Or big windstorms like we're supposed to have tonight here in Utah and your roof blows off, you've got it, that kind of stuff. Great questions, Lise. What else you got?
I think we covered most of what I was going to ask. I think it's just so important that people know what it costs for long-term care. Do you know statistically how many people need long-term care?
I do. So 70% of people over the age of 65 need some type of care, and actually 1 in 5 need care for 5 or more years. Here's the problem, Elise. Most people think they're in the 30%. And since they think they're in the 30%, they don't put a plan in place. But here's what we know. We know that most men and women who've invited people into their lives and promised to take care of them will do something to make sure that the consequences to their family members are not detrimental. So we are seeing more and more people bring the conversation up. Maybe COVID brought it front and center because of all the nursing home deaths and all the issues that we had. But I've never seen a greater interest in being educated on the need for care, who needs it, why you need it, what it can do if you have a plan in place. And certainly, I believe it's a love insurance. I have a plan so that my kids will talk to each other when I die, and so that they can wipe my brow, not my behind, right? So, I think that's certainly something to keep in mind when you're having discussions with your family and your friends about long-term care.
I love policy. I like that.
Yeah. No, I love the way you put it, Alicia. One of the things that I took away from one of the first classes I attended that you put on was that most people aren't going to a nursing home as a first choice. It's a last choice. And it's usually preceded by people trying to take care of people themselves at home, which tends to result actually in more chronically ill individuals, usually via back injuries, trying to lift and help and do all they can to keep them at home as long as they can. And now suddenly there's 2 people that need it. And so having a plan in place and a funding mechanism in place with the plan allows the loved ones to supervise the care and make sure their loved ones are getting the best care without risking their own health in the process.
You're 100% right. Taking care of the chronically ill can make you chronically ill. And oftentimes, too, Scott, I don't know if you know this, but oftentimes the caregiver predeceases the person being cared for because it literally kills them. And that sounds horrible, but that is a true statistic. So it's not just good for you, it's good for your family. But you think about it like this. If you have whether you have a plan or not, somebody's going to take care of you. It's not your life doesn't end, someone else's does. And I think people fail to understand that.
Yeah, not necessarily literally, but like you mentioned, the oldest daughter in closest proximity being the default caregiver. Um, we actually have a couple of clients, one in particular that comes to mind, who literally quit work way prematurely. She happened to be the only daughter, and she was unmarried and no children. And so she literally put her life on hold, quit her job, moved back home with the folks and took care of him, which then compromised her future and her ability to prepare herself as she needed to in order to provide that care. So, not that, she wasn't willing, obviously she was, and she did, not that, you know, any of us would want to say we're not willing to sacrifice for our loved ones, but that is a huge sacrifice when there are much better alternatives available.
I agree 100%.
Anything else that you think we ought to have shared or talked about? I love the statistics. There was a CLTC class that you and I were at together in Phoenix a few years ago. At least it only seems like a few years ago.
True.
It may have been more than a few. And we were going through statistics, and the 70% number is a real thing. There's going to need to be some type of care. And I think everybody recognizes that. And if it can be, minimal and you're still in your own home, awesome. But there are still things that are needed. And it does change the dynamic of the finances and the family relationships. But then there's kind of a gradual continuum. But boy, if you get into a skilled nursing facility, particularly with a cognitive impairment, the average duration there, last I remember reading, was over 8 years.
8.2 years, you remembered well.
And the cognitive facilities tend to be more expensive on average than traditional skilled nursing. And so if you're talking $10,000 a month, $120,000 a year times 8.2 years, do the math. That just wiped out most people's portfolio and then some. So, food for thought.
And think about it too, Scott. If you're married and you have a spouse in a memory care unit and you spend all the assets, what does that do to the surviving spouse?
No, they're done. Not only was their life put on hold for that entire period of time, but then they don't have any options because of lack of resources to do the bucket list things that everyone talks about when they talk about with their eyes bright and sparkly about their retirement, which usually includes travel and spoiling grandkids or whatever the list might contain. Now there's just no ability anymore to do that. It's sad. And it doesn't have to be that way.
Agree.
Awesome. Well, Alecia, it's been so much fun. So you're off to San Diego next week?
Yes, sir. Yep. Next week, I'm going to the ILTCI conference, which is the largest long-term care conference in the country. It's once a year. I'll be speaking, and I helped actually put together the sessions for agents and advisors. So looking forward to hanging out with a bunch of LTC nerds, including myself.
We're grateful for you.
Yes. Amen. Yep. Amen. Well, Alicia's got all of her insurance licensing under her belt. She's working on her registered investment advisor license. That's kind of the big one.
Wonderful.
And then the CLTC designation needs to be on her list.
Sounds like a plan. I'll let you know when we have our next class.
That'd be swell. Appreciate you so much. Appreciate all of you back there at FIG. You make us look good and you help us be better. So appreciate you taking the time today, Alecia. It's been so much fun.
You got it. Y'all have a great day. Good to see you.
Bye.
Thanks.
If you found this information useful, please share it. If there is something you hear that raises a question, you can sign up for our free consultation as well as sign up for our free newsletter. Visit AskScottNelson.com to sign up. Thanks for listening. Remember, if you plan well, you can retire happy.
The information provided is for educational purposes only and is not intended as investment advice for anyone. All information discussed is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of SLN Financial Incorporated and do not necessarily represent the views of Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory and financial planning services are offered through Alpha Star Capital Management, LLC, an SEC-registered investment advisor. Alpha Star and SLN Financial Incorporated are independent entities.